$5.5 trillion. That's the debt bomb Congress just lit with the One Big Beautiful Bill Act. According to the Congressional Budget Office, this fiscal expansion accelerates Social Security insolvency from 2035 to 2032. 3 years gone. With Jerome Powell's Fed Chair term expiring May 2026, we're looking at a triple threat to U.S. economic stability. Current national debt, $38.56 trillion. That's 1.8 times GDP. The Committee for a Responsible Federal Budget warns this expansion pushes debt to GDP to 1.5 times historical highs by 2034. Powell, 72 years old with 12 years at the Fed, faces his final term amid this fiscal deterioration. The timing couldn't be worse. Markets are already pricing in monetary policy uncertainty. Social Security Administration data shows 40 million beneficiaries at risk. The trust fund, projected to last until 2071, now faces depletion by 2032 under this fiscal scenario. That's a $1.48 trillion shortfall acceleration. But here's where it gets interesting. The Center for Budget and Policy Priorities projects benefit cuts of 40% if insolvency hits. Translation: $1,900 average monthly benefits drop to $1,140. For institutional investors, this means massive reallocation pressure from fixed income to equities as boomers chase yield. Now watch this number carefully. With 10,000 Americans turning 65 daily, the demographic cliff accelerates funding pressures. Powell's Fed has kept rates elevated to combat inflation, but fiscal expansion forces an impossible choice: accommodate Congress and fuel inflation, or maintain hawkish stance and risk recession. Treasury yields spike risk, massive. Bond market exposure to fiscal dominance theory kicks in when debt servicing exceeds 7% of GDP. We're approaching that threshold. Equity sectors face divergent impacts. Healthcare and consumer staples benefit from demographic trends. Financials get squeezed by rate volatility. This is the part most people miss. Fed independence comes under political pressure when fiscal and monetary policy collide. Powell's successor inherits an impossible mandate: fund government spending or maintain price stability. For institutional portfolios, 3 key metrics to watch. 10-year Treasury real yields above 2% signal fiscal stress. Social Security disability insurance reserves hit zero first. That's your early warning system. Fed fund futures pricing in 2026 shows market expects dovish pivot regardless of inflation. And here's the kicker. Modern monetary theory advocates argue debt sustainability differs for reserve currency issuers. But bond vigilantes disagree. Foreign treasury holdings already declining as China and Japan reduce exposure. Risk management requires hedging both inflation and fiscal dominance scenarios. Contrarian take: productivity gains from AI could boost GDP growth above debt service costs. Historical precedent shows post-war debt reduction through growth, not austerity. Powell's replacement might embrace yield curve control, capping long-term rates regardless of fiscal expansion. The bottom line: $5.5 trillion fiscal expansion plus Social Security insolvency plus Fed leadership transition equals the most dangerous policy mix since the 1970s. Position for higher rates, lower bond prices, and political pressure on Fed independence. This isn't just fiscal policy, it's a stress test for American economic credibility.